Hello and welcome to this F6 revision mock debrief. Now you would have already done your revision mock, and this short video serves to do a little bit of a debrief of what you just saw in your revision mock. So I'm going to go through the questions that we've just seen in the revision mock. The first question you would have seen in your mock was a typical question that you would expect in question 1 of the exam, which is to do with income tax. So if we look at the requirement of the question for the first part says calculate Karen's tax adjusted trading profit for the 5 months to 31st May 2014. And remember, when there is an and, there's more than one requirement in there. And the taxable trading profits for 13, 14, 14, 15 and 15, 16. So when I see the requirement telling me to calculate the tax adjusted trading profit, straight away I know that this is going to be adjustment of profit. Okay. Now, with adjustments of profits, you can expect to start with your profit as per the question, and then have some disallowed expenses, maybe some capital allowance calculations, and that's the sort of things that we would expect in the adjustment of profit. The second part of the requirement is to calculate the taxable trading profit. So this means we may have to apply the basis period rules. The basis period rules are different based on where the company is in its life cycle. So is the company a starting company? My apologies, where the business is in its life cycle. If the business is a startup of a business, then we will apply the opening year rules. If the sole trader has been trading for many years, then we would apply the ongoing rules. And if the sole trader has been trading for many years, closing down, then we would apply the closing down rules. So the first part of the requirement has got two requirements in there. One is the adjustment of profit, second is the basis period rules. The next requirement is to calculate the income tax payable. This means we're going to have to prepare the income tax computation. The income tax computation for an individual will include different types of income. So from here I can see that Karen has got some trading income. So there's going to be some trading income. And maybe there is a possibility of Karen having other types of incomes as well. And we have to calculate the tax that is payable. The third part of the requirement is to calculate the national insurance payable by Karen. Now, national insurance, again, depends on what type of income the individual has. If the person has got employment income, then the national insurance that applies is Class 1 primary and Class 1 secondary. If the person has got some benefits, then it's Class 1A. However, if the person is self-employed, then it's Class 2 and Class 4. Clearly, we have to see what Karen has got before we can decide what national insurance that would be applied on Karen. You're told here, assume that the rates and allowances of 13, 14 will apply throughout. And then we are told Karen's mum, Jean, she was born on the 8th of February 1942. She's received some state pension and she's got some interest, and to calculate the income tax that is payable. This means we need to calculate the income tax computation for Jean. Now, what's interesting with this question is the fact that she was born on the 28th of February 1942. And if somebody was born on the 28th of February 1942, then they apply for what we call the personal aged allowance. If you look at the personal allowance given to us in the rates page with Karen's mum, clearly she was born between 1938 and 1948. Therefore, the personal allowance that will apply will be 10,500. However, if her income is above 26,100, then the personal allowance will be reduced. So If we go back to Karen and see what information is given to us in the question, you're told on the 31st of December 2013, Karen resigned as an employee of Banner Foods Limited, and the company had employed her as a food technician since 2001. So she resigned in December 2013. This means that she was employed for 9 months. On the 1st of January 2014, Karen commenced self-employment running her own gourmet food production business, preparing accounts to 31st May. The following information is available. So what we see is that on the 1st of January 2014, she started her own business. Okay. So for the first 9 months, we have her employment information. We are told that during the period, her total gross salary during her employment was 40,000. Now notice this was given to us for the period from April to December. And we were also given the pay as you earn deducted out of her salary. During the period 6th April 2013 to 31st December 13, Banner Foods Limited provided Karen with a diesel-powered motor car. So what we see here is that we're going to have some car benefit. Now, if the examiner brings in benefits, we expect the common benefits to come up, and the most common ones are the living accommodation and the car benefit. So here we've got the car benefits, and in order to get the car benefit, we require the list price. And we are told that she made a capital contribution of 7,500. However, the allowable maximum amount that can be deducted is 5,000. So if we just briefly look at the answers, we will see that we've taken the list price of the car minus 5,000 maximum. Although she did contribute 7,500, we can only deduct maximum of 5,000, and then we multiply it by the CO2 percentage. Now we were told here that the car was a diesel powered car and had a CO2 emission of 140. So we can round down to the nearest to the number that is divisible by 5, and when we round down to a number that is divisible by 5, that is why we get 140. 140 minus 95 divide by 5 plus the base of 14, because it's a diesel powered car, and our percentage is 23%. The car benefit is calculated by taking the list price minus capital contribution multiplied by the CO2 percentage, and then time apportioned. Time apportioned because Karen was only employed for 9 months of the tax year. We're also told that she is paying £100. I'll just quickly bring up the question. We're told that she is paying £100 per month towards the use of the car and £50 per month for the fuel of the car. Now, the amount that is contributed towards the fuel of the car is ignored. However, the amount that she pays towards the use of the car, also known as the revenue contribution, is taken into account. So this is the car benefit. The next note we have over here is to do with interest, and we're told she received an interest-free loan. So what we have here is known as the interest, or rather known as the loan benefit. Okay, we're told that the loan was 80,000 and she repaid 50,000 on the 5th of July 2013, and the balance was paid off on on the 31st of December. Now, because there was some part payment over here, we need to use two methods. The first method being the the average method, and the second method being the precise method. Now, one thing we've got to be very careful of, and this is a question I often get with regards to loan benefits. If you look at the length of the loan was 9 months. It wasn't a loan that was available for throughout the tax year. In this tax year, the loan was only for 9 months.